As we welcome in a new year, it is out with the new and in with the old. Here's what we mean by that. Just check out the action in today's trade. Newcomer, Affirm, tanking 10%, while Central JP Morgan rallying nearly 4%. Poshmark sinking nearly 7%. Macy's adding 2.5%. Block, formerly known as Square, taking a big hit. Legacy player MasterCard, though, seeing a pop. That trend playing out across sectors as rates rally. The 10-year Treasury yield up 30 basis points in just 10 days. So is this the same old, rising rates hitting high valuation stocks, or is there more to this story this time around? Dan, Nathan, what do you say?
Yeah, well, Mel, we saw this earlier in the year, earlier last year, in the very beginning of the year when rates started rallying, and we saw a lot of the names that you had up there that were down today had huge 2020s, and they gave a lot back in early 21. Investors were revaluing some of these growth stories, assuming that we were going to see decelerating growth on the other side of the pandemic. Well, the interesting thing is that things got incrementally better with the vaccines and in certain parts of the economy opening fairly fully in 2021, but a lot of those stocks kept on going lower. And when you look at some of the drops, you had Square there, that stock had already dropped 30% before today's drop. So to me, what I think is really interesting is that this is the similar action that we saw in early 2021. We saw rates rise, but the real focus here is how much rates were going to go up at this point. We know that they topped out in Q1 of 2021, the 10-year at 1.77. We're not far from that right now, but there doesn't really seem to be a whole heck of a lot of indication that the 10-year is going much higher very quickly, very soon.
I guess that's really the underlying question here. If rates are capped, let's just say they go up to and test that 177 level or thereabouts. Karen, does that mean that valuation, high valuation names trade better? Or is this part of a valuation reckoning? Investors are really turning away from these names and looking at value at this point.
I think you're right. I think this is sort of a reckoning because last year when Dan talked about it, at the same time, the Fed was very much there. There was no discussion of when they would taper or when they would raise. Now, obviously, that is very much on the table, and that is the expected outcome in the short term. So I think even if rates go a little bit higher and stop there, one could make the case that those support high multiples. But the idea of the sentiment of the Fed being there for us no matter what, I don't think that's there anymore. So also, I think that the divergence between the high flyers, which just had, almost lost any gravitational pull toward value, versus the low PEs got so huge that, there's still a lot of convergence left to go. So yeah. I think there's more of this.
Right. So there's a lot more to this rotation than we're seeing right now, Tim. Where would you go?
Well, and before we discount the fact that rates can't go much past 175, which everyone's rightly pointing out has been a level they've struggled, that uptrend from August 2020 is still very much alive with the 10-year, and if anything, tells you that it's put in a lot of hard work to maybe make a test well through 175, probably up to 190. But, so let's go back to a Block versus a MasterCard. Look, MasterCard trades at a multiple around 30 times next 12 months. That's 5 or 6 turns cheaper to where it was pre-COVID. The ticker on Square, Block, whatever we're calling it, is still not something that really makes sense. The fact that you're going to see a lot more activity in crypto and blockchain, I don't think anybody really questions at this point. Whether that's going to disintermediate and essentially box out MasterCard, I would highly, highly doubt. In fact, I think MasterCard and Visa are going to be there for the long term for transactions that are certainly done in digital, but also in crypto. And I think it's a case where people are evaluating whether these new economy stocks are really worth paying the multiple for. So it's a combination of, yes, I actually think rates are putting in the work that they're supposed to do. And remember where we were going into COVID and roughly where rates should probably normalize at, maybe even higher in an environment where the Fed's more aggressive. But I think it's a case where there's a little bit of both going on. I do think valuations matter significantly, but I also think you can't be an old economy stock without being around and having evolved into the new economy. So whether you're a financial institution, obviously you're involved in fintech, but whether you're a retailer, this isn't just about e-commerce plays. And so a Macy's or some of these other days of yore names that have actually reinvented themselves, of course they have. And that's really the story here. I think a lot of these legacy businesses have evolved. It just hasn't been as sexy on the front line.
Yeah, I mean, we're saying old stocks, and we use that in quotes, Guy, because there is somewhat of a convergence. These older line businesses are finding ways to become more digitally forward. I mean, if you take a look at, as Tim said, Macy's, its direct-to-consumer strategy, its online strategy is working. JP Morgan, a lot of the other financials are looking for ways to become more fintech-y. And so is part of this just getting recognized for that part of the valuation, which was undervalued previously?
They've been forced to, right, for a good reason, and now they're being recognized, I think, because of everything the guys and gals just said, because the market's now concerned about valuation for the first time in a long time. It's interesting, there are all those fun sayings in the markets, you know, sell in May and go away, things that I'm just loath to say because it just makes me, like, squeamish, like that, like wince. But there is one, you know, don't fight the Fed, which I tend not to say either. But if it's true, if it's a mantra, David Tepper talks about it all the time, typically you don't fight the Fed when they're adding liquidity to the system and the market's going higher. But if that mantra is true when they're easing, shouldn't it necessarily be true when they're tightening? So why would you want to fight them now? And I think that's what you're seeing in some of these high growth, high valuation names.
But the argument is that tightening won't impact valuations too much unless rates goes considerably higher from here. So if I were to tell you, Dan, which what? Guy.
Which I think they are, by the way. Now, I've thought that for a while incorrectly, but I'm going to stand by it. I think 10 years are have a beeline to 2%.
To 2%. Okay, I think that, I mean, 2%. Show of hands, 2% rates on the 10-year. Will that mean that stocks pull back in general?
By
Raise
when?
your hand. By when? I mean, I'm just trying to figure out, is 2% the line of the sand? If I were to say, Dan Nathan, right now, that rates hold 1.7 and go not a basis point higher, what do stocks do? How does that change your investment strategy?
I think what these guys are also kind of hinting at is that the Fed is kind of painting themselves in a corner. I think we would all agree that this taper is coming way too late here. And so we're debating about where rates are going to be in the 10-year. We already know that investors in the bond market have already taken the 2-year where they think it should be here. And so the notion that we're going to be done with this taper fairly soon, they are not going to change their course on that. But the idea that we're going to have 3 rate hikes in 2022, I don't know, man. I mean, you can look at the CME Fed tracker there, and you can look at the probabilities of that. But there are so many curveballs, and we know what Fed Chair Powell had to do in late 2018 after they were raising rates, I think, a quarter point every other meeting. And, you know, we had a Fed funds that got above 2.5%. The stock market went down 20% in a straight line, and they went and got really dovish. I just think that when you look at what went on in the stock market today, there are real companies with real market cap that got taken off of because of valuation. I'm just going to point to one in particular, and it's Shopify. And this fits all the stuff that you guys were talking about as it relates to fintech and innovative sort of companies kind of changing, you know what I mean? Like, we've spent so much time talking about Amazon over the last 15 years. I think Shopify is that company for the next 10 years. It lost 10% today. It was already down 20-some% into today. And so that's investors saying, okay, well, we were at 30 times last year's sales for a company with a $125 billion market cap. That makes no sense. And there you go. They re-rate it. And that's what's going on, I think, all over the market. And then there's these ones that we've spent way too much time on. The Twitter, the Snapchat, the Pinterest, they all made 52-week lows today. They're all down more than 30-some% from their 2021 highs. There's stuff going on in the stock market that investors who buy stocks, who are not passive investors, better pay attention to, because we were talking about it on our call before. We're all a bit older. We're all a bit grayer. We remember how things come unraveled, and this is one way it does.
I mean, Karen, on that call, you were saying this reminds you of 2000?
Yes, it does. I mean, we had the internet bubble obviously burst in 2000. And so you had all of these high flyers and people just couldn't get out fast enough. So they would fall every single day, a lot. And then you had names that were, you know, like at Allstate Insurance or things that were just boring old companies that traded at low PEs. And that's where you wanted to be. And so this reminds me of that. So, you know, we brought up JP Morgan. I think of like JP Morgan versus Nubank. When they went public, Nubank was 10% of the value of JP Morgan. I found that absolutely astonishing. Or if you look at, you know, we talk a lot about Square and PayPal and how they want to take over and be your bank and be your everything. And they trade at these incredible multiples. But if they're going to be your bank, are they going to trade at a bank multiple? That chasm was so wide. And I think most of that, if it does converge, will come from the high flyers coming down. Because even though things are down a lot, a firm's down a lot, it's not like it's super cheap, right? But I would look at something like a Bank of America and say, it's still pretty cheap. Even though it's up, $5 in 2 days, still pretty cheap.
A lot of these companies, though, are companies for the future. Maybe they shouldn't have traded where they had traded before. So are there any, Tim, right now that you have on your list, sort of keeping an eye on? If it gets low enough, you might pick it up?
Well, I mean, look, I like Palantir. I own DraftKings. Karen talks about Zillow. I kind of agree with a lot of these. So these are stories that for different reasons got tweaked significantly higher. I just think that we're going to have a fascinating conversation with Paul Sankey later on in the show. I mean, think about some of these carbon footprint oil companies that are going to be carbon neutral in 15 years, and just the world is changing, and I just think we are reassessing whether flagship companies who already have brands, who have infrastructure, who have distribution, who have logistics, they're worth a lot, and there's no reason why they shouldn't be making some of these adjustments. And again, you have the extremes at all sides. Another one of these pairs we talked about was Roku versus Viacom. Karen's Viacom, by the way, and by the way, it's had a good couple days. It's a case where Viacom and Roku on a trailing basis, 135 times for Roku, 7 times or 6.5 times for Viacom. Now we know Viacom has their problems. But at the end of the day, they have content. They have distribution. They are showing that there's actually an evolution into a streaming model. And I think this is something that investors as well as customers are evaluating almost simultaneously.